Okay, what we're looking at today is F2 Management Accounting. In particular, what we want to consider is what management accounting is. What is it used for? And the distinction between management accounting and financial accounting. Now, if this is the case, the first thing we have to consider are the uses of management accounting. Secondly, we want to look at it in relation to financial accounting, and then we get into the bits and pieces. Firstly, what is information? In particular there, we want to consider the distinction between information and data. Secondly, the qualities of information. What qualities would we like in our information that allows us to use the information appropriately for management accounting? Thirdly, we want to make a distinction between strategic, tactical, and operational requirements. And finally, what we want to do is look at all the different types of centres. In essence, what we're doing here is we're trying to understand the language of management accounting. If we understand the language of management accounting, everything we do in F2 from here on in will make sense to you. So whatever we do in the next couple of sessions, you must focus on making sure that you have a full understanding of each and every term. In themselves, I don't think that they are difficult at all. But if you don't know what these terms mean, when we come to apply the terms later, again and again and again in F2, and if you wish, extending into your F5 studies, even into your F9 studies, and your P4 and P5 studies, you will always be in the dark. So, it all starts here. If we understand the language, we will quite easily be able to understand the relatively simple ideas that are present in F2. Now, the first thing we want to look at is why we need management accounting. So what is management accounting? Well, it is an accounting system that provides information for internal use by management. And if you think of what managers have to do to run the business, we could separate their tasks into three areas. The first area is that they must plan for the future. If they don't plan for the future, the company will fail. The company will fail because sooner or later, the company will be out of step with its environment. Secondly, we have to control. What we mean by control is we must compare our actual results to those that we originally thought we were going to achieve. If we don't have effective controls, again, the company may fail. Let's look at it from a personal perspective. If you don't plan what you intend to do over the next weeks and months in your studies, do you expect to be successful in the exam? The answer is probably not. If you don't control what you actually do in relation to your original study plan, do you expect to be successful? Again, the answer is probably not. So when we look at planning and control, these are regular events that companies must have information for on a weekly, monthly and annual basis. We also have a third component. The third component that management need information for is to make decisions. If we were to look at the sort of decisions that a company may make, they may have to decide whether to invest in a business or not. You know, buy another company. And if that's the case, we have to look at the appropriate costs and revenues associated with that. They may have to decide whether to launch a new product or discontinue a product. And again, they'd have to look at the appropriate costs and revenues. So when we look at decision making, the key difference between decision making and planning and control is this. Planning and control is regular, monthly, annually, possibly even weekly. Whereas when we look at decision making, this is more of an ad hoc process. We make decisions as and when necessary. They are not necessarily regular. They could arise at any point in time. So if we get those ideas down, the uses of management accounting. 1, planning. It forces us to look to the future. 2, control. It allows us to compare our actual results to those that we originally expected and take corrective action. And 3, decision making. I will tell you that when you look at F5 or P5, you may be looking at more sophisticated ideas at the higher level papers. But in essence, this is all you're doing, and you heard it here first. So, we now know what it is that we're attempting to do. The next thing we have to do is say, well, if that's the case, what sort of information do we need in order that we can plan, control, and make decisions? And I suppose what you could say is that we need 3 separate types of information. But when we look at information, there are some basic qualities associated with the information that will always hold true. The first distinction that we have to make is this. What is the distinction between data and information? Well, if we're looking at data, I suppose what we're looking at here is the raw data. The information, very difficult to say this. Raw data. These are the facts and figures that we originally gather. The key feature associated with data is that it is unprocessed. A number in its own right doesn't make much sense. If I said to you that a company was making a profit of £100,000, would you say that was good or bad? Well, I suppose what we're saying here is it's a profit, it must be good. But if I then tell you that the company is worth many hundreds of billions, you would say, well, hold on a moment, that's not very big at all. So the issue of looking at information is that we take the basic raw data, and what we do is we make it useful. We put it into context. The way we put it into context is that we may compare the data to something else. We may calculate a ratio. But one way or another, we put it in a form that allows us to make decisions. So a very simple idea this. The distinction between data and information is that data is unprocessed. It is the raw material, if you wish, for the system that we're looking at. Information is what we need. Information is what we are going to use to plan, to control, to make decisions. And of course, our role is to move the data into a form that it is information. That is what we get paid for. So, given that we now know the distinction between information and data, now let's focus on the information and consider what qualities good information would have. If I were to ask you a question, let's say I said to you, what are the directions to the station? What qualities would I expect from you in the answer? If you said to me in response, blue, what am I going to do with that? Is it possible that the first quality is that your answer must be relevant to the question? So, if I asked you for directions to the station, I'm looking for you to come back and say, well, you walk 100 yards down the road and you turn left and things like that. Secondly, I would expect the information in timely fashion. I'm hoping you would give me the information immediately rather than walking off and coming back in half an hour's time. Thirdly, cost effective. I suppose what we mean by cost effective is simply this. If I asked for directions to the station and you said, well, that's going to cost you £200, I may decide that I will find the route myself, rather than relying on your very, very expensive directions. 4. Accurate. Okay, I've asked you for directions and you tell me that it's somewhere over there. You're probably correct, but how accurate is your answer? Somewhere over there could be in an arc of 90 degrees, and I could still get lost. So from this perspective, we're looking at information being sufficiently accurate that we can make decisions. Now hold on a moment. Given that we've looked at some of the core elements associated with good information, we now see that relevance, timeliness, cost effectiveness and accuracy may work against each other. If we're looking at cost effective, we do not want the information to cost too much. So we're looking here at balancing cost to benefit. So we may accept a slightly lower level of accuracy in order to ensure that the cost is not too high. Secondly, if we're looking at timeliness, we may say that roughly accurate information today is better than wholly accurate information in 2 or 3 or 4 days' time. So we have to weigh up one against the other. When we're looking at the qualities of good information, the sort of questions that you get in the exam here will simply say, which must we have? And when we look at the questions, normally the answer is pretty obvious. I've given you a selection of the qualities that you could expect. Of course, there are a number of other qualities that we could also introduce, things like reliability and consistency. And the key when we're looking at qualities of information is simply common sense. What is information used for? It is used to allow us to make decisions. If we can't make decisions from the sort of information that you're talking about, well, it's not good enough. Let's move on. Our next consideration is that we want to look at different types of information that the company may use. You see, when we look at a company, we may split it into 3 different management areas: strategic, tactical, and operational. The distinction between strategic, tactical, and operational is simply this. The strategic level is the highest level of management, looking at the long term. Tactical level is looking at middle management, the medium term. Operational, junior management and supervision, very much the short term. So, if we say short term, I would suggest that operational was anywhere from a day to a week up to a month. Tactical was monthly reporting up to annual reporting. And strategic was anything beyond 1 year. Let's look at it from a personal perspective. If you are looking at your holiday for next year, you could maybe argue that where you intend to go is a strategic decision. It is the long-term decision, it is the overall decision concerning where you and your family wish to go on holiday. How you get there, whether you fly, drive, walk or cycle, is a tactical decision. So how you achieve your strategic aim is tactical. And what you do when you get there, whether you have an ice cream or you go on the bouncy castle, is an operational decision. It's a day-to-day decision. Now, what we tend to focus on in management accounting at this level is tactical. We want to consider what happens on a monthly up to an annual basis. But let's just get some ideas down before we forget them. Operational, tactical, strategic. We said that strategic was the highest level of management. I don't know how much you know about companies, but I suppose what we're talking about here are senior managers and directors, the people who run the business from the top. And what we're looking at here is anything over 1 year. When we look at operational management, we're looking at junior management. And I suppose what we're looking at is daily and weekly sort of information. And when we look at tactical levels, we're looking at middle management, whatever that term means, and we're looking at monthly and annual information. Now, if we were to go any further, what we could do here is we could make this sort of distinction. As a strategic decision, almost everything that we focus on will be about planning, looking to the future, and trying to understand the course of the business, in which direction we are going. When we look at operational decisions, we're looking mostly at control. As a junior manager, you don't necessarily plan. Instead, the plan is imposed upon you and you simply follow instructions in direct relation to policies and procedures that somebody else has put in place. The area that we're focusing on is the tactical level. And what we have here is the planning. As we will see later in the course, we have something called budgeting. But in addition to the budget, preparing a plan for 1 year, normally in financial terms, we also have to control in relation to that plan. So, if we were to make a distinction between strategic, tactical and operational, the way I like to look at it is simply this. Strategic is long-term, operational is short-term, and tactical is somewhere in between. Now, sort of related to what we're talking about here, one thing we can do is separate up the business. So what we can look at here are centres, a means of separating the business into smaller elements. Why do you think we do this? Well, yes, if you have a large business, it's very difficult to understand all the costs and revenues in relation to that business. So if we can break the business up into manageable chunks, that way we are better able to manage it. Now, we start at the lowest possible level. We have cost centres and revenue centres. Now, I don't wish to embarrass you by telling you what you already can see for yourself. A cost centre is a grouping of costs. A revenue centre is a grouping of revenues. All we're doing is trying to break up the costs into appropriate areas. When we look at a cost centre, we tend to look at functions. Now, a function could be a product line, the different products that we sell. It could be managers. If you make a manager responsible for individual groups of costs, maybe it is easier for you to do the budgeting and the budgetary control. It could be location. If the costs relate to a building, why don't you make that building a cost centre? It could be to do with a region. Maybe we could have a northwest region and a southeast region and separate the costs that way. the most common way that we see that costs are separated are into departments. And we will see in the future that we talk about production departments and administration departments and things like the canteen where you eat, and maybe service or maintenance departments. But a cost centre is simply a logical grouping of cost, which allows us to better control those costs. If we look at a revenue centre, all we're focusing on is a logical grouping of revenues. Maybe we are talking about a grouping of revenues around a product line. That would make sense. Or we may have revenues in relation to a region. But again, we are identifying the revenue centre in much the same way as the cost centre, on the simple basis that we can put somebody in charge of those centres in order that they have to achieve results. Now, it won't surprise you to know that if we combine costs and revenues, we get a profit centre. If the cost and the revenue centres are managed by relatively junior managers, the profit centre will be managed by someone just a little bit more senior to them. And what we're seeing here is that the profit centre will be managed with a view to managing both, yes, costs and revenues with a view to generating profit. I suppose what we're saying with a profit centre is that the centre must be sufficiently large for it to be a business entity. That means that the manager can be controlling both revenues coming in and costs going out. And this may mean that we're getting somewhere near to a divisional operation, a wholly autonomous part of the business where we can identify revenues and costs relating to that business. Now, there is one final step. We may develop the profit centre into something called an investment centre. When we look at an investment centre, we're talking about a relatively senior manager, and they have control not just over the revenues and the costs, but they are also able to make a key decision within the business. That is, whether or not to invest money in the business. Now, capital expenditure is normally very closely controlled in a business, on the basis that if you spend money on a capital asset and everything goes wrong, the money is immediately lost. Therefore, you're only going to see relatively senior managers responsible for investment centres. So to recap here, if you have a junior manager in control of a cost centre, their aim is to control the costs to a predetermined level. If you have a junior manager in control of a revenue centre, their aim is to control the costs, the revenues, again, to a predetermined level. If you have a slightly senior manager, they're in control of both costs and revenues. And if they're in control of costs and revenues, you could say that they're aiming to achieve a profit target, or you could argue that their aim is to maximise profit, to make as much as they possibly can. Finally, when we look at an investment centre, the manager in charge of an investment centre, yes, is charged with the job of making profit. But this is the key point. In an investment centre, because the manager is responsible for the investment, we would look at profit in relation to that investment. Some of you may have come across the term return on capital employed. All we mean here is we're taking profit in relation to the capital invested to make that profit. So, we've made a distinction here between the differing types of control centres we may have. Now what we want to do is to make a distinction between what management accounting is and what financial accounting is. Some of you may have some background in financial accounting. If not, don't worry. the list that I'm going to give you is going to be comprehensive. If we look at the distinction between management accounting and financial accounting, the first thing we have to do is to understand what financial accounts is. As some of you may know, financial accounting is about providing information for external users. Traditionally, the key users of accounts would be shareholders, the owners of the business. Having said that, there are many other users as well, maybe the taxman, maybe our creditors, and lots of others. Secondly, about financial accounting, we are looking at a statutory need to prepare the accounts. Law determines that we must prepare financial accounts and lodge them with Companies House on an annual basis, or whatever the equivalent is in your country. Thirdly, there is a specific order in which we must lay the information out when we're looking at financial accounts. And four, there are specific rules as to how the information must be prepared. So when we look at financial accounts, what we're looking at here is a statutory need laid down by rules and a particular order for the layout. Remember, it's all for external use. I think we can understand that there is a logic to this because this allows the external user to compare one company to another. If we were now to say, how does that compare to management accounts? Let's just think about this for a second. External users are the users of financial accounts. But we've already learnt that the management accounts are used for internal use. Remember, the management accounts are allowing the internal users to plan, control, and make decisions. So maybe that's the first idea we can get down. Internal use for management accounts, external use for financial accounts. When we looked at financial accounts, we said that there was a statutory requirement. This means that being a financial accountant, you are safe because you know there will always be a job for you. Every company needs to prepare its own accounts. When we look at management accounts, does anyone care on a statutory level whether we prepare them or not? Well, the answer, of course, is no. They are for us. They are not for use by government, shareholders, or anybody else. Therefore, we would only use management accounts if the benefit of so preparing them outweighs the cost of preparing them. Thirdly, there are rules associated with how we prepare our financial accounts. We can't just prepare them how we like. There are rules and regulations. Whereas when we look at management accounts, there are no rules. If you wish, we can make it up as we go along. What we're going to find, unfortunately, is that because we tend to provide information for the financial accountant, we tend to be beholden. We tend to have to stay within the rules of financial accounts. But we don't have to. The only reason why we do that is that it makes sense to have a single accounting system that provides both management and financial accounting information. And if you have a single accounting system, yes, it does have to adhere to the financial accounting rules. If we look at financial accounts, one thing we would say about financial accounts is that it has to be in financial terms. It only makes sense to prepare information in pounds and pennies, dollars and cents, in order that it is comparable from one company to another. Whereas when we look at management accounting, yes, we will prepare information in financial terms, but we will also prepare it in non-financial terms. This is not something we get very excited about at paper F2. But when you look at your continued studies at higher levels, what you're going to see is that there is a big move to introduce non-financial measures to better assist management. And so what we tend to have is a mix of financial measures and non-financial measures. But that is a long way forward in your studies. If we were to continue, when you look at your statutory accounts, they are prepared on an annual basis. There is an annual cycle for which accounts are prepared. And if you wanted to be more clever, you could say that larger companies prepare reports on a quarterly basis as well. But the statutory requirement is that we report things like your, well, I would like to call it a balance sheet. I know that when you get to financial accounting, it becomes something slightly more sexy. The balance sheet is prepared for a point in time, and the income statement prior to that balance sheet is normally for 1 year, the standard accounting period. Whereas when we look at management accounts, we've said, yes, we will look at it on a monthly basis, and also we will look at it on an ad hoc basis. Remember, when we look at decision making, we make decisions as and when necessary. It doesn't concern us that there is a specific cycle. Finally, when we compare management accounts to financial accounts, what we could say here is that we're looking at detail. In order to plan, in order to control, in order to make decisions, we have to get down to the absolute detail, normally unit costs, and the breaking down of the unit costs. Whereas if you look at financial accounts, they are in summary. And this leads us to the very last point, which is financial accounts relate to the past. If you look at any financial accountant, my view is that they should be walking backwards, because they focus on the past and they never look at the future. It's amazing that they don't fall down a hole or something. Whereas when we look at information from our perspective, yes, we will focus on the past. We have to consider what's happened in the past in order to plan for the future. But we will also have to consider the future. One of our key roles is, remember, planning, and another one, decision-making, both associated with looking to what is going to happen in the future. So, these are the sort of ideas of the distinction between management accounting and financial accounting. I don't think it's very difficult for you to understand. I hope not. It's the sort of thing that will be reinforced again and again in your studies at this level and at higher levels. All I'm trying to look at here is how we may deal with the sort of questions that you would look at in F2. So, what we've managed to do is to introduce the sort of environment that we're going to talk about from here on in. We've considered planning, control, decision-making. We've considered what information is, and we've considered a little bit of terminology.